Norfolk's commercial real estate market is at a crossroads. Office vacancy are hitting new highs, retail spaces are struggling to retain tenants, and rising debt costs are squeezing property owners. But meanwhile, institutional investors are shifting their focus away from riskier assets, leaving many sectors in limbo. Some investors see uncertainty and hesitate, others see opportunity and act. The key is knowing which trends to watch, which to avoid, and where the best deals will emerge. So if you own, invest, or considering commercial real estate in Norfolk, you need to know how to position yourself before the market makes its next turn. And let's break it down. Norfolk's commercial real estate landscape is changing, and there are 5 major red flags every investor should be watching. First, vacancy rates are rising across key asset classes. Office properties are struggling with hybrid work models becoming permanent, causing long-term vacancies in formerly high-demand areas. Retail properties are also seeing a slowdown, mainly in non-designated shopping centers where foot traffic continues to decline. Even multifamily properties are experiencing higher turnover as tenants seek affordable housing options in nearby cities. The problem is compounded by increasing supply in certain submarkets, creating excess inventory and driving rents downward. This situation leading to a cycle of price cuts, shorter lease terms, and higher concessions from landlords just maintain occupancy levels. Additionally, tenants in both residential and commercial spaces are negotiating more flexible lease terms, further reducing landlord pricing power and lengthening lease-up periods. 2. Transaction volume is declining. Many property owners who purchase assets at historically low interest rates are unwilling to adjust their prices to match current financing realities. This has led to a standoff between buyers and sellers, slowing down deal flow and preventing fresh capital from entering the market. The result is an increased number of off-market deals and seller financing arrangements as investors look for more creative ways to close transactions. However, those who fail to adapt to new market conditions may find themselves stuck with assets that become increasingly difficult to offload. With fewer transactions occurring, property valuations are becoming more uncertain, making it harder for investors and lenders to underwrite deals with confidence. Third, operating costs are climbing fast. Insurance premiums have surged due to Norfolk's exposure to hurricanes and rising sea levels. Maintenance costs and property taxes are also increasing, cutting into investor margins and making it harder to maintain profitability. Additionally, inflationary pressures on labor costs and building materials are making renovations and capital improvements significantly more expensive, discouraging property upgrades that would otherwise increase asset values. Property owners are now forced to assess whether their capital improvements will yield sufficient rent increases to justify the expense. And in many cases, they're choosing to defer maintenance, which could lead to further depreciation in asset value. Fourth, lenders are tightening up. Regional banks that previously fueled Norfolk's commercial real estate market are becoming increasingly selective, requiring more equity borrowers and offering less favorable terms. Deals that once worked under 75% LTV or loan to value ratios are now being restructured or failing to secure financing at all. Furthermore, debt maturities looming in 2024 and 2025 could force many investors into distressed sales. Mainly those who relied on short-term bridge loans now require refinancing at higher stakes. Some investors who had planned to refinance or hold their properties long-term are now considering strategic exits as they struggle to make their debt service payments. And fifth, institutional investors are repositioning their portfolios. REITs and private equity groups that were once bullish on Norfolk's market are reallocating funds to industrial and medical office sectors, leaving office and retail properties struggling for capital. This shift signals a larger trend that individual investors need to account for. More importantly, smaller investors who lack access to institutional-grade financing will have to compete with cash buyers and well-capitalized firms looking to acquire assets at distressed prices. As major institutional players pull out of high-risk markets, private investors may find it increasingly difficult to secure partners or financing for large-scale projects, shifting the balance of power in commercial real estate. Now, these 5 factors are interwoven, creating a cycle of hesitation and uncertainty in the market, and investors who recognize these warning signs will be better positioned to capitalize on the market inevitably corrects. To understand where Norfolk's commercial real estate market is headed, we need to look at the hard data. According to CoStar, Norfolk's office vacancy has climbed to 17.2%, one of the highest in the region. This represents a significant jump from pre-pandemic levels, signaling that demand for office space is not rebounding as quickly as many expected. Meanwhile, Meanwhile, retail vacancy rates have increased to 8.5%, driven by store closures and changing consumer habits. Additionally, subleasing activity has risen sharply, suggesting that businesses are downsizing footprints to cut costs. The sublease market is often an early indicator of future distress, as companies try to unload excess space to signal that office sector may be facing more prolonged structural shifts. A report from the Federal Reserve Bank of Richmond actually highlights that loan origination for commercial properties in Norfolk has dropped by 35% year over year. This reflects not only stricter lending conditions, but also investor caution. In previous cycles, similar declines in lending activity preceded significant price corrections, as reduced liquidity forced sellers to lower their pricing expectations. A prolonged period of low transaction volume often leads to price discovery delays, meaning that it could take another 6 to 12 months before the true impact of valuations becomes clear. The Hampton Roads Economic Development Alliance has reported steady job growth in military, defense, and contracting and healthcare sectors. However, the office-dependent industries such as corporate finance and traditional business services have seen a stagnation in employment, reducing demand for commercial office space. This suggests that while certain sectors remain resilient, others are seeing structural declines that could have long-term consequences for Norfolk's office market. Employers who previously occupied Class A office building in downtown Norfolk are now reconsidering their space needs, with many opting for smaller, decentralized office locations. Institutional investors' behavior is shifting as well. Major data shows that institutional investment in Norfolk's commercial properties has dropped by 38% over the past 24 months. Instead of broad-based commercial real estate acquisitions, investors are focusing on logistics, data centers, and high-quality multifamily properties in stable submarkets. So some investment funds are also taking a wait-and-see approach, delaying acquisitions until asset prices adjust further. With institutional capital drying up in certain sectors, secondary market investors and high net worth individuals may have an opportunity to acquire underperforming assets at a discount. Adding to the concerns, rising property expenses are straining landlords. Utility costs, property tax reassessments, and required building upgrades for energy efficiency clients are making many assets less attractive to long-term investors. Many landlords who previously locked in favorable financing terms are now experiencing negative cash flow, forcing them to either offload properties or inject capital to stabilize their holdings. Property owners who purchase at peak prices fail to anticipate rising operational costs, may be forced into sales that reshape Norfolk commercial real estate landscape. The data is clear. Norfolk is experiencing a shift, and those who are ignoring the signs could be left behind. Most investors assume that high interest rates are the biggest challenge in today's commercial real estate market, but there's a much larger and more immediate risk. Norfolk's growing inventory of distressed assets. First, many property owners are trapped in unsustainable financing structures. A significant number of investors purchase properties using short-term loans, adjustable rate financing, or low interest debt assumptions. With interest rates now much higher than their original financing terms, refinancing has become an unsurmountable hurdle for some landlords. In Norfolk, properties purchased between 2019 and 2021 are particularly vulnerable, as they were underwritten at historically low interest rates and aggressive valuation projections. These owners are now facing negative leverage where their debt costs exceed their net operating income. The wave of distressed property sales is just beginning. Second, the wave of distressed property sales is just beginning. Many landlords are trying to hold on, waiting for a market rebound that may never come. However, as more loans come due in 2025, we will see a spike in forced sales when highly leveraged owners cannot refinance and their only options are fire sales or loan defaults, which create a ripple effect across the entire market. Early signs of distress are already evident in Norfolk's Class B and Class C office buildings, where delinquency rates on commercial mortgages have climbed to the highest level since the Great Recession. Third, Norfolk's insurance crisis is worsening the situation. Rising flood risks, hurricanes, and unpredictable weather patterns have pushed insurance premiums all the way up by over 30% year over year for some commercial properties. This is a silent killer for asset owners, many those who are already struggling with thin margins. Some insurers are refusing to renew policies for properties at high-risk flood zone, forcing owners into far more expensive coverage. This increase in expenses is making otherwise viable properties financially unstable. Fourth, government intervention could accelerate the problem. Norfolk City's council is currently reviewing potential tax reassessments on commercial properties, mainly those with declining occupancy rates. If enacted, these policies could raise tax property burdens on struggling assets, further eroding profitability for owners already dealing with rising operational expenses. Additionally, stricter zoning laws and energy efficiency mandates could add significant capital expenditure requirements for landlords, pushing some over-leveraged owners into bankruptcy. And fifth, Norfolk's downtown office sector is at high risk of long-term value destruction. With vacancy rates climbing and employees reducing office footprints, many Class B and Class C office spaces may become obsolete. The longer these buildings sit vacant, the harder it will be for landlords to lease them without major capital improvements or drastic rent reductions. This is an existential crisis that to some office investors who may have to position their properties for alternative uses or exit at a steep loss. Investors who only focus on interest rates and short-term lending conditions are missing the bigger picture. The combination of rising insurance costs, mounting distress, and government-driven expenses is creating a perfect storm for Norfolk's commercial real estate market. Those who fail to prepare for these risks could see their portfolios devalue rapidly, while investors who position themselves wisely may uncover once-in-a-generation buying opportunities. There's one economic indicator that historically signaled major real estate downturns, and Norfolk has just crossed this critical threshold: the spread between cap rates and borrowing costs. First, when borrowing costs exceed cap rates for an extended period of time, it forces property prices downward. Historically, when this has happened in major real estate cycles, it triggered asset repricing across all commercial real estate sectors. Norfolk's current cap rate for multifamily properties is averaging 5.8%, while borrowing costs on new commercial loans have risen to 7% or higher. This means many investors are now experiencing negative leverage, where they're earning less on their investments they are paying in debt service. In past cycles, this led to large-scale selling pressure. Second, forced selling is inevitable. According to the Mortgage Bankers Association data, more than $1.2 trillion in commercial real estate loans will mature nationwide by the end of 2025, with a significant portion concentrated in mid-tier markets like Norfolk. This means that many property owners who purchase at low cap rates will be forced to either sell their properties at steep discounts or inject significant additional equity through refinance. For over-leveraged investors, neither option is sustainable. Third, historical market conditions tell us what happens next. In every real estate cycle over the past 50 years, when the spread between cap rates and borrowing costs remain compressed for too long, a wave of distressed assets sales follows within 12 to 24 months. Between 1989 and 1991, cap rate compression led to a 58% drop in commercial property transaction volume. We saw similar properties in 2008 in 2010. Norfolk's market conditions today resemble these past downturns in alarming ways. Fourth, commercial mortgage default rates are climbing. The latest TREP CMBS data shows that delinquency rates on commercial mortgages in Norfolk have increased by 20%, signaling growing financial strain among property owners. With banks tightening, lending standards, refinancing is becoming nearly impossible for some landlords, accelerating the probability of forced sales. And fifth, corporate bankruptcies are driving up commercial vacancies. As national retailers and office tenants continue to downsize or shut down, Norfolk's commercial vacancy rates are rising faster than anyone could expect. This is mainly concerning for shopping centers and Class B office spaces which rely on long-term tenant stability. The higher the default rate, the greater the likelihood of landlords will face declining cash flows, putting even more properties at risk. So the data is clear. Norfolk's commercial real estate market is heading toward a correction, and investors who recognize these signs early can prepare for both risk and opportunities, while those who hesitate may find themselves caught between a downward spiral of devaluation. Investors who want to navigate Norfolk's commercial real estate market successfully must take proactive steps, and here are some strategies to capitalize on the shifting landscape. So first, target distressed multifamily properties. Norfolk's rising vacancy rates in some multifamily submarkets mean that investors may be able to acquire well-located properties at discounted rates. Look for assets where landlords are struggling with debt maturities or rising insurance costs. Two, capitalize on office to residential conversions. Norfolk's high office vacancies mean that some buildings will need to be repurposed. Investors who secure assets early for conversion to residential or mixed-use properties will definitely have an edge. Focus on industrial and logistic assets. Norfolk's port and military base ensures steady demand for industrial real estate. Investors should prioritize warehousing or distribution centers in strategic locations near major transportation corridors. Secure financing before lending conditions worsen. Lending standards are tightening fast, and investors who secure financing now, while capital is still accessible, will be in a stronger position when interest rates rise further. Diversify into resilient asset classes. Sectors like medical office, self-storage, and data centers have remained strong, and performers even in these downturns. These high-demand asset types could help investors stabilize returns. Monitor distressed sales and pre-foreclosures. The wave of distressed sales is just beginning, and investors should track properties with debt maturities and establish relationships with brokers, lenders, and loan servicers to access these off-market deals. The key is liquidity. Investors who stay flexible and have available capital will be able to acquire prime assets at steep discounts when the correction accelerates. The Norfolk commercial real estate market is shifting fast, and the next 12 months will define the next decade of opportunities. But this is just one part of a bigger trend. In our next video, we'll break down Virginia Beach's commercial real estate outlook and compare investment highlights across the Hampton Roads. Subscribe now, turn on notifications. Looking forward to seeing you next video.